Coming up, the government's mid-year outlook, what it says about the economy, iron ore prices the highest in more than a year, and we take a look at the investment opportunities for 2024. That's next. It's your daily 10-minute business and finance news wrap for this Wednesday, the 13th of December 2023. On Market Day, we'll speak with James Gerrish from Shaw and Partners for his take on the opportunities to look out for in 2024. But first, to the government's mid-year economic and fiscal outlook, updating the bottom line for this financial year from a $13.9 billion deficit to a smaller $1.1 billion deficit. That's thanks to a rise in revenues from both taxes and from rising commodity prices. And it comes as the government's forecast for near-term inflation has risen a little. And for more on that and the economic impact, I spoke with Rynne, Chief Economist at KPMG.
MYEFO is now suggesting that the Australian economy is really just limping forward in the rest of this financial year. There's been a revision downwards in GDP, down to 1.75% for financial year 24, and then a slight revision upwards into financial year 25 of about 2.25%. Now that's operating well below long-run average, and it's just suggesting that monetary policy is seriously biting in the economy, particularly around consumption expenditure.
I have seen, though, a commentary which says that it shows another larger than expected boost to revenues with smaller deficits now. So where's the money coming from?
So in essence, what you're seeing is with the incredibly low levels of unemployment, the government's now achieving very high levels of personal income tax receipts. So what we're seeing is the fact that there's been a resilience within the labour market is now generating tax receipts over and above what the government had anticipated only 6 months ago.
We all know, though, that the unemployment rate will eventually rise. Is there a threat to the government's forecasts if what happens to the labour market is worse than expected?
There is, but what there's also been is quite realistic assessment of where the unemployment rate is going to go over the short term. An expectation of an unemployment rate peaking at around mid-4.5%. And at the moment, that suggests that there's still some way to go with regards to numbers of job losses over the short term. Even with that increase in the unemployment rate, we're still getting pretty strong growth in tax receipts and a moderation in government spending.
Okay, what about the way the government is working with the RBA? Are they working hand in hand to make sure that inflation comes down? In other words, is there any part of this update that's inflationary?
I don't think this current update is any more inflationary than what was had in the previous budget. Now, what we're seeing, though, is that government spending still is very high. Government spending on infrastructure is still very high, and that is adding to pricing pressures within the economy. I'm sure the Reserve Bank would prefer that the government cut spending even more than what it's proposed within MYEFO, so that it takes some of the pressure out of domestic demand, particularly around wages growth that's adding to services inflation. But nonetheless, it's not adding any more to inflation, but it's just meaning that inflation is taking longer to come down than possibly could be the case.
And finally, what does this update say about the outlook for interest rates?
Unfortunately, what this outlook does suggest is what most market commentators, including ourselves, have been saying is that rates are going to stay higher for longer. Now, I don't necessarily think that we're going to have another cash rate increase, but what we will see, though, is continued increase of interest rates being charged by the banks as their wholesale funding costs increase for a variety of reasons over the next couple of months, including the fact that the term funding facility provided by the Reserve Bank during COVID is now going to run out, and swapping from cost of funds of 0.1% to at least 4.5%. Means that there's an average increase of around 25 basis points for the banks who have used that term funding facility. That's the equivalent of one Reserve Bank movement. Now, what we will see, however, is that the Reserve Bank probably hold the cash rate where it is, at least for the next 6 to 9 months, and probably start to pull it down towards the end of next year.
Brendan Rynne there, Chief Economist at KPMG.
Now, Market Day on the SBS On The Money podcast.
The Australian share market rose today. The S&P ASX 200 up 0.3% to 7,257. For more, I spoke with James Gerrish from Shaw and Partners.
Yeah, a combination of things, Ricardo. I think probably low volumes coming into Christmas, but we've had a pretty solid rally in iron ore stocks and broader commodities. So that's been a highlight for the market today.
Before we talk about iron ore, macro themes, US inflation in line with expectations, down from 3.2% annually to 3.1%. What does that say about the US economy and, more importantly, the implication for interest rates? Because we know the Fed meets tomorrow.
Yeah, they do. I mean, to give you some context around US inflation, it peaked in June of 22, above 9%. So down here at 3.1%, it's been a big move in the right direction. Bond markets, so expectations around interest rates have moved a lot in that period as well. So the US 2-year bond yield is down sort of 50 basis points, 0.5%. From the recent highs. So there's no change expected tonight over in the US around interest rates. The key to tonight's discussion is going to be around their economic projections. So the Fed dot plot and also the commentary coming out of the press conference following the meeting. So the market, if I look at where market expectations are, the market's pricing over 1% of interest rate cuts in 2024. So the market's well and truly turned to a more dovish stance.
How does Australia compare? Because inflation here is still dramatically higher. What's interesting, though, is yesterday the RBA Governor Michelle Bullock said, quote, Australia isn't falling behind the rest of the world in its fight against inflation. Does the market believe that?
Yeah, it seems to. So bond markets are telling us that the market certainly believes that. If you think about when our inflation level peaked, we were in December of 2022. So after the peak in US inflation over there. So where you rightly point out, we're at high levels still. We're above, we're mid fives from an inflation perspective here. In Q3, the Q4 number, which will be out in January, is expected to show a number sort of mid fours. So we're tracking in the right direction. Our bond markets, which are forward-looking instruments, their pricing and interest rate, they've come back about 50 basis points, 0.5% as well, in line with their US peers. So we're not pricing the aggressive nature of cuts yet in 2024, but we're getting there. So there's some cuts being priced in next year for the RBA. Obviously, inflation is going to be key to that, but we're tracking in the right direction, Ricardo.
You mentioned earlier those iron ore stocks doing really, really well today. Fortescue at a record high. Rio Tinto its highest since July 2021. Can you run us through it? Because I know that the iron ore price has been doing really well lately. We also heard from the government and its MYEFO update today. It's seeing revenues rise thanks to higher commodity prices. I think the iron ore price right now is $135. The government expected it to be $60.
They weren't the only ones getting it wrong. So the bulk of analysts, so what we call consensus, had iron ore trading sort of around that $80 a tonne. So it surprised many in the market, and that's probably one of the reasons why the likes of Fortescue and Rio have been so strong. So in September, Fortescue was trading around $19. It's now $27 higher today. So it's been a pretty significant run. I think there's a couple of things at play here. Firstly, obviously, the Chinese property market's been front and center. We're all concerned about that, but that's not the only engine that drives the Chinese economy. Automobile manufacturing has been really strong. Infrastructure development has been particularly strong over there, but also China's a big exporter of steel globally. So global economic conditions have held up a lot better than perhaps the government had thought they would, as well as many analysts out there. So you put all of those things into the mixing pot, and you've got iron ore trading a lot higher than many expected, and the likes of Fortescue trading at all-time highs, as you made mention of.
One of the big stories to come out in recent days is that of Sigma. It's returned to the market today in spectacular form. Shares up around 70% at one stage following news of its proposal to merge with Chemist Warehouse. What's your take on this? And is there still a risk, though, that the ACCC could block the deal from going through?
Yeah, this is a big deal. It's an interesting deal. To put some numbers around what Sigma will look like post the acquisition if it goes through of Chemist Warehouse, it'll be just shy of $9 billion market cap. Sigma before the deal was about a $1.5 billion market cap. It'll be just a shade smaller than Qantas. It'll be slightly bigger than the likes of Treasury Wines, Seek, Ampol. So it's a big deal. There is still the concern that the ACCC will have an issue with it. It does change the competitive landscape out there. And today's trading has been, the huge range that we've had today. It's been a 35% trading range today. It shows how, I guess, the indecision out there around what's going to transpire, particularly from an index point of view. So this will mean it's something between a 50 and 60th biggest stock on the ASX. Obviously, that has index ramifications. So it's going to be interesting to see how it plays out from here. And I guess the indecision in the market today is shown through that big variance in prices. It opened sort of at north of $1.30 and has had a low just below $1 today.
Finally, this is the last time I'll speak to you this year, so I'm keen to get your outlook in terms of where do you see the opportunities for investors in 2024?
Yeah, I think, what the market's pricing right now is sort of this Goldilocks scenario. So by that, I mean that central banks have done enough to curb the threat of, to curb inflation, to bring inflation back down towards targets. They're not there yet, but they're coming back down towards targets. But they haven't done enough to crimp growth. So, that is a really positive backdrop for equities. So if I put on my, glass half full view of the world, then the Goldilocks scenario plays out in 2024 could be a phenomenal year for equities. If that's the case, then I think there's a couple of areas that would deliver well for investors. Property's been really beaten up in 2023. I think that's going to come back. Some of these commodities, so copper's had a reasonably tough year in 23. I think that'll do well in 24. Gold is an interesting place. So in that economic environment, the US dollar trades lower, and then that could be a really positive backdrop for gold. So I'd caution that by saying that we need to stay vigilant. There's still a lot to work through from an economic standpoint. So staying vigilant, being active. But at the moment, we're seeing signs that 2024 could be a really good year for equities, Ricardo.
James Gerrish there from Shaw & Partners.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.